I don't think that most business buyers understand quite the full impact that taxes are going to have on the cash flow of their business. Now, taxes take a big bite out of your cash flow because if you're using an SBA loan or any other type of loan, you have to pay taxes on money you don't actually receive. You have to pay taxes on the money that's used on the principal to pay down the loan. You only get to deduct the interest portion of your payments. So when you first take out your loan, a majority of your loan payment actually goes to pay interest, and a small portion of your loan payment goes to pay principal, which means you get a bigger tax deduction in those early years. And then also, that coincides with some other tax benefits. You get the first year, you might get some depreciation benefits, and of course, throughout the entire lifetime of your loan, you'll likely have some amortization benefits. But that interest deduction is bigger in those first few years of your loan. But over time, as your payments become more principal payments, that's great because it means you're paying down your loan, you're not paying interest, but it also means that your tax rate goes up. So check out this chart that we have. This is for an actual business that we're looking at. This actual business is located in California. So we have California state taxes. And this just shows what the after tax, after loan payment, after everything cash flow is going to look like over a 10-year period, assuming no growth at all. We're just going to keep revenue, expenses, and cash flow just flat the entire time. So look at the last year where we have our loan payment. We have negative $30,000 in cash flow to the owner. And this is for a business that's generating $1.3 million of SDE today. And that's because in year 10, your principal pay down and your loan payments is $810,000. And then your taxes are going to be around $375,000. And then don't forget, we need to spend about $100,000 on CapEx to buy new equipment to keep the business running. So that leaves the owner with only negative $30,000. Now, the good news is over long periods of time, inflation can actually work in your favor and actually dilutes down those loan payments. So let's just say that we're going to grow our revenue with inflation of 2%. And we're going to grow our expenses at 2%. So if you just keep up with inflation, we can see here that our cash flow is positive in every year. Obviously, we're not doing great. So let's look at a little better scenario where we're outpacing inflation a little bit. So let's say that we're growing revenue at 4%, our expenses are growing at 2%. Then this gives us a situation where we can maintain a much more steady cash flow over that 10-year period, as shown in this chart. And you can see the final year, it's $360,000. So outpacing inflation can have a big impact, and you need to make sure that your business can outpace inflation. Now, I think looking at this is why you really want to work with a professional, experienced business buyer. The banks, when they actually do your underwriting, they don't account for taxes. So in a lot of instances, what might look like a good debt service coverage ratio on a pre-tax basis and that you'll be able to get a loan actually means that your cash flow is around zero after taxes. So you can't count on the bank to save you from yourself when it comes to the underwriting of your taxes. So if you want to buy a business with us and use our experience and our time that we've spent buying businesses over the years to your advantage, check out the link in our bio and let's buy a business together.